You don't test the impairment of cash, right? You don't. So you first want to identify what should be tested. Okay. Before you do anything, you have to see what is the job, what is the work, right? And then second stage, you do the testing. The last one, you recognize the impairment in a financial statement. So that's the 3 stage. Normally, you would follow each stage, right? Stage 1, stage 2, stage 3. But when I go through these slides, I realize it's really awkward if I follow this order. I have to do stage 2 first, okay? Otherwise, you'll be confused with step 1, okay? So let's do stage 2, impairment test, okay? And then we'll go back to 1, 2, 3. So when you do impairment test, essentially you are comparing 2 values, okay? The carrying value, you can also call it a net book value, with recoverable value, recoverable amount, okay? So then we need a definition for recoverable amount. What is the definition for the recoverable amount? Okay, so you can recover the value through 2 ways, right? First, you sell it, okay? Then it's the asset's fair value less the cost to sell. How much can you get from this asset by selling it? Well, the fair value less the cost to sell. That's how much you get out of the asset by dispose it, right? Well, you can also use it, right? The value in use, right? The recoverable amount is the higher of the asset's fair value less cost to sell and its value in use. Whichever is higher, that is the recoverable amount. If your net book value is higher than recoverable, then the asset is impaired. You have to write it down. Okay. If the carrying value is less than recoverable amount, there's no impairment. There's no requirement for write down. Does this make sense?
Sorry, can you say the net book value? I kind of missed that, or it didn't register. The net book, if the net book value is higher,
yeah,
then sorry, I missed that last bit there.
Then the recoverable amount, you have to recognize the impairment, right? Because you are reporting a value more than the recoverable amount. You are exaggerating the value. So you have to write it down to recoverable amount.
Okay, thank you.
Anyone else? Does this make sense? So far, does that make sense intuitively? We're going to talk more about it, right? Okay, I will move on then. Let's take a look at this question, okay? Due to increased competition from low-cost foreign manufacturers, GT company is experiencing significant declines in sales. Okay, that seems to be a bad news. Significant declines in sales, okay? The company produces its toys from an assembly line. The equipment in this assembly line has not been previously revalued or impaired. Okay, this is the first time the economic situation signals that maybe the asset does not worth as much as before. Okay, for the year ending December 31st, 2020, the company controller gathered the following information: original cost 4 million, cumulative depreciation 1.2 million, fair value 1.7 million, cost to sell 100,000, and then incremental cash flows. That's the net cash flows generated from the equipment. That will be 500,000, 0.4, 0.7, 0.8. Okay. Risk adjusted cost of capital is 12%. Okay. Risk adjusted cost of capital of 12%. If you take finance courses, you should know what this means, right? Okay. Can anyone tell me, okay, what is the net book value? What is the carrying amount?
Is it 2.8 million?
Very good. For 4 million minus 1.2, right? So original cost minus cumulative depreciation, right? That's your net book value carrying amount. What is the fair value less cost to sell?
1.6 million.
Yeah, 1.6 million, right? Fair value 1.7 minus 100. Okay, so then what this, if you sell it, that's the amount of money you get, right? 1.6 million. What about the value in use? If you use it, if you don't sell it, if you use it, what is the value in use?
2.4 million.
How did you get it?
The incremental cash flows.
Okay, so you summed all the future cash flows, right, together?
Yeah.
Okay.
Do
But
the
But
cash
you
flows
need
need
to
to be
discounted,
discounted? Yeah.
okay, yeah. There's one information here called the risk-adjusted cost of capital, 12%. That's the discount rate you are going to use. So instead of sum up the undiscounted cash flow, you have to do a present value of the future cash flows and using 12% as the discount rate, okay? So my value in use is the present value of the future cash flows. That's the calculation, okay? That's the calculation. So I got $1.7 million, okay, $1.771 million. So this is the value in use. If you use it, if you don't sell it, use it, the value of this. If you sell it, 1.6, what is the recoverable amount?
So the higher of the value in use and the fair value minus cost to sell.
Yeah, the higher, right? And in this case, it is
1.7 million.
very good. So that's the recoverable amount. What's your carrying amount? 2.8. So 2.8 is what you reported. The value we are saying here is recoverable is 1.7, right? So why there's a big difference? Because the significant declines in sales. So these numbers are smaller than originally expected, right? So do we need to do impairment or not? Is there an impairment?
Yes.
Yes. You are reporting too much. It really should be 1.7 million. You are reporting 2.8. Okay? So there's impairment loss. Does this make sense?
So I have a really easy question here, but where did the how was the 2.8 million calculated again?
Oh, it's the 4 million minus 1.2.
Thank you. That was easy.
And sir, I have a question too.
Yeah.
So I thought impairment is for non-current assets, right?
Yeah, this is the equipment. Equipment is non-current asset, right? So long-term asset, equipment.
Okay, yeah.
Yeah? Okay, anyone else? Any other questions? Can I move on?
Yep.
Okay. Now let's talk about the first stage, okay? Sorry, it's a little bit, now you see why I'm doing this, okay? Now you see why I'm doing this. First step is what to test for impairment. Like I said, you don't test impairment on cash, right? Cash is current asset, right? You consider whether item generate cash flows independent from others. You need to separate all group assets into cash generating units. Cash generating units, the smallest identifiable group of assets that generates cash inflows that are largely independent of those from other assets. Did you see this cash flow stuff, right? If I talk about cash flows right away, you'll be confused, right? Why I'm talking about cash flows. But now let me ask you, when we talk about cash generating units, talking about separate cash flows, why? Can you tell me why? If you have no answer, I will be really sad because I failed. It should be quite obvious. If you didn't pick it up, I feel really, really sad. Okay, you rescue me, please. So why they
Could you
talk
repeat
about
the
cash?
question, please?
Why do they talk about when you talk about impairment? Why cash generating units are relevant? Why separate cash flows are important?
Is it because you can put a value to it?
Thank you. I really appreciate it. Because otherwise it's such a waste of my, because you can see that, right? They talk about the cash flows here, right? They talk about this separate cash flows. Because in order to do the testing, you have to figure out what's your value in use, right? In order to do the testing, you have to figure out what's your recoverable amount. And you have to figure out what's your value in use. For value in use, you can only calculate if the equipment, the eyesight, has a cash flow, right? Has a future cash flow that you can separately identify, right? And then you discount the cash flow to figure out what's the value in use, right? So that's why you have to figure out first, you want to see, is this asset a cash generating unit, right? If it does not generate cash, then you have to think about, the asset group, right? The asset group. What would be a good example, right? Let's say in order to make shoes that you can sell, you need 3 different machines, right? You need like a machine A that can sewing. You need a machine B that can packaging, right? So you cannot test impairment just on machine A, right? Because machine A on its own does not generate the cash flow. In order to generate this shoe revenues cash flows, you have to see the whole group, the 3 assets. The 3 assets machines together can make shoes, can generate cash flows. So when you do the impairment testing, you cannot just test on the individual assets machines. You have to test the whole group. Does that make sense? Yes or no?
Yes.
Yes? How about the
Yes.
rest of the class?
Yes.
Yes? Okay, that's the whole point that I'm talking about here, why they talk about cash generating units, right? That's the level of the units you are testing, okay? And so it's the smallest identifiable group of assets, generate cash flows that are largely separated, independent from others, right? Only under this condition, you are able to calculate what's the value in use for this unit, right? You can do this impairment test. Otherwise, you cannot even do this impairment test because you don't know the value, you don't know the number, right? Make sense?
Yep, makes sense.
Okay, good. That's the whole thing why I talked about step 2 before this, okay? And then the IAS, okay, 36, require enterprise to test an asset for impairment only if there are indicators of impairment. You don't have to do this annually, okay? But you have to search indicators, right? So in this case, can anyone tell me, before I do the test, right? Before I do this calculation, what are the indicators telling me I need to do an impairment test on the equipment?
Because of the significant declines in sales.
Thank you. Awesome. Very good. Because your cash flows, future cash flows will down, right? Very good. Thank you. That's the indicators. So that pushed me to do this test, right? If there's no indicators, everything runs normally, I don't have to do the impairment test. Okay, what would be some indicators? Internal source of information, you observed evidence of obsolescence, physical damage on the machine. If you have a different plan of using the asset, means the cash flow structure will change, right? So then maybe the value in use will be different. And then external source of information, market value asset has declined. Adverse changes to technological, right? Your technology is outdated, right? There's new technologies there. Maybe people will not use your technology, therefore it does not generate as much cash flows as before you think. Increase in interest rate, right? If interest rate increase, your discount rate will increase. So your present value of future cash flows will decrease. Your value in use decrease, your remarkable value amount could be lower, right? So market value of enterprise as a whole is less than carrying value, right? The market value of the company is less than its carrying value, right? Those are all the indicators that you probably think, oh yeah, maybe some troubles, I have to do an impairment test. Exceptions, okay? Exceptions to IAS 36 is intangible assets with indefinite lives and goodwill, okay? So this is an exception to the intangible assets with indefinite lives and goodwills. You have to test this for impairment every year. For intangible assets with indefinite lives and goodwill, you have to test impairment every year, okay? So for patent, for goodwill, you have to test it every year. Okay, here's the question. I want to see if you understand this, okay? So if you need more participation mark, make sure you answer the question, okay? So true or false question. First, enterprise should test all tangible assets for impairment annually. True or false?
False.
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 False, right? False. Only there's indicators, right? Only there's indicators. Enterprise should test all intangible assets for impairment annually.
True.
False.
Why? Why wrong?
False.
False.
They have to have an indefinite life, right?
Yeah,
Yes.
It's just
exactly.
not all intangibles.
Yeah, exactly. For intangibles with finite lives, they are still, there's no requirement for annual testing, right? The exception is only for intangible assets with indefinite lives.
Indefinite lives.
C, enterprise should test goodwill for impairment annually.
True.
True.
Okay. For all tangible assets, enterprises should annually search for indication of impairment.
True.
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 Oh,
True? Yeah, because you have to search for
Annually.
indications of impairment. You don't have to do the impairment testing, but you have to search for the indications, right? E, for all intangible assets, enterprises should annually search for indications of impairment.
True.
False.
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 Why is false?
You don't need to do it annually.
For the intangible assets with indefinite lives, right? You just do impairment testing, right? You don't search for indications, right?
okay. Yeah.
And do you do that annually? Or just
Yeah,
once?
yeah. So
Annually, okay.
for intangible assets with indefinite lives, you do annual impairment test. Yeah. So F, enterprises should annually search for indications that the goodwill is impaired.
False.
False, yeah. Because you don't do that. You just do the impairment testing. That's required annual impairment testing, right? Right?
Yes.
You know you have to do it. Why would you search for indications? Right? So are we okay with this?
Yes.
Okay. so impairment test. I mentioned about this slide already, and you understand why I moved a little bit ahead. I want you to know value in use, okay? I want you to understand the concept of value in use. Fair value less cost to sell seems to be pretty straightforward. What's the fair value less cost to sell, right? If you have a house of $1 million and you pay 3% of commission fee, the real estate agent fee, and then there are legal fees, right? There are legal fees involved. So at the end of the day, you sold it for 1 million, you probably only get 950,000, right? So that would be the fair value less than cost to sell. You know, so they talk about the fair value in order of preference in terms of reliability. If you have sales agreement, then that price, the number written on the agreement, that will be very reliable. Otherwise, if you are in an active market, right, you can see the market price. Then third, if you don't have, if this item has no active market, but a similar asset, okay, has a market, right? You can also use those as a proxy, right? So the preference order is getting lower from 1 to 3, right? You will prefer a contracted figure on the contract agreement. So the fair value, okay, fair value. Cost to sell, cost to sell. Okay, value in use. Value in use is the present value of the future cash flows expected to be derived from an asset, okay? Right, we have seen that, right? We do the calculation, right, together. Must first define the unit that produces those cash flows. Is this unit has 2 machines or 3 machines or only 1 machine in order to generate that cash flows? This discounted cash flows is a standard technique used in finance, right? You have done that a lot in the finance course, right? In the 3460,
3470.
3470,
Yes.
and what's
There's
the
a lot
other
of cash.
3400,
3040.
3040. Okay, I forgot. I took these courses many
It's
years
okay.
ago. Yeah, but anyways, I trust that you have done a lot of this, right? You have done a lot of this stuff. Value in use. Okay, now let's do a question here. Okay, November raincoats uses 3 different machines to manufacture raincoats. Okay, due to climate change and changes in customer preferences, demand for raincoats has declined in recent years. The following information is relevant to the valuation of the impairment. First of all, what is the indicator for impairment? Is there such indicator?
Less
Demand
sales.
for raincoats has declined.
Yeah, very good. So now this first step, right? There's the indicators. Now you tell me, what are the cash generating units? What's the smallest identifiable cash generating units generate cash flows that can be separately independent from other cash flows?
Machine A?
Hmm?
Is it machine A?
Machine A?
Yeah.
If you see machine A, right, the value in use is not applicable.
Hmm.
That means there's no cash flows just generated. A, that's independent of B and C, right?
So all 3 would be the smallest.
Yeah, all 3.
All 3, you can see total, right? There is a value in use. And you can read from here, the company uses 3 different machines to manufacture raincoats. These 3 machines have to depend on each other in order to generate cash flows. So one machine on its own cannot generate independent cash flows, okay? So that's why this cash generating unit is the group of asset with the 3 machines ABC. Does that make sense? Say yes.
Yes.
Basically here, let's take a look. Now we are at the second step. We are doing the impairment test. What is the fair value less cost to sell? 4 million? Yeah, 4 million?
Yes, yes.
What's the value
4
in
million.
use? Value in use?
3.8
3.8.
million.
3.8.
Yeah, what's the recoverable amount?
4 million.
4
4
million.
4 million, the higher of the two,
Higher.
right? And now you compare recoverable amount with net carrying amount, 4.5 million, right? Is there a loss?
Yeah, 500,000.
Yeah,
Yes.
500,000.
Yeah, because the recoverable amount is 4 million and you report it as 4.5. So there's you are over reporting. So you have to write it down, right? Write it down as an impairment loss of 500,000, right? Are we good?
Yep.
Yes.
Okay, good. Now, if recognition of impairment, if the impairment test involve a single asset, that is easy. All the things related to this asset, right? You have to write down the impairment loss on the asset, right? If there are, okay, if it's a cash generating units with more than one asset, the enterprise need to allocate the impairment loss to the different assets. Okay, here you have a total impairment loss, 500,000, right? How much you gonna allocate to A or B or C, right? That's a very good question, right?
A weighted average or sorry, weighted percentage or
Yeah, those are all very good, intellectual guys, right? Guesses. So let's take a look at here. Okay, let's talk about this allocation rule. Okay, there's a rule in terms of allocation of impairment loss to assets with a cash generating unit. So IAS 36, you allocating impairment loss in proportion to the net carrying amount of the asset in the cash generating units, like what you said, Paul, right? Proportion to the net carrying value, okay? But there are exceptions. There are exceptions. If that unit include a goodwill, if that cash generating unit include goodwill, the impairment loss will first go towards reducing the goodwill before any further allocation, okay? If after reducing the goodwill to be 0, there are still remaining balance to be allocated, then we're gonna, but the first step is you have to first reduce the goodwill, okay? And the second rule is if the asset are unimpaired on its own, no loss would be allocated. If that asset on its own is not impaired, you should not allocate the impairment loss, right? Okay. Now, oops, boy, this is bad. Okay, what should I do? Close your eyes, okay? Close your, okay, anyways, what happened here? Okay, so now let's keep going. Okay, let's keep going. So you have $500,000 impairment loss, okay? How am I gonna allocate this loss across A, B, C, okay? First, let's take a look at A, okay? Let's take a look at A. Let's take a look at A. So value in use is not applicable. So the recoverable amount is fair value less than cost sales is 1 million. Net carrying amount is 1 million. For A, is there any impairment?
No.
no.
No. So should I allocate impairment loss to A?
No.
No. That's why you can see this column is empty here, right? Let's take a look at B and C. For B, recoverable amount is 1.2, less than 1.5. For C, 1.8, less than 20. So for B and C, both impaired, right? So I should allocate the 500 to B and C, right? Using the same proportion according to the net carrying value, okay? So what's the net carrying value? For B, net carrying value is 1.5. For C is 2. Total of B and C is 3.5. And what's the proportion? So proportion for B is 1.5 divided by 3.5, okay? And the proportion for C is 2.0 divided by 3.5, okay? And so I figured out the percentage proportion is 42.857 for B, 57.143 for C. I'm gonna use the same percentage applied to this impairment loss. So that's how I get this allocation. So 214, 286 for B, 285, 714 for C. Okay. Total, that's 500. Nothing is allocated to A. Does this make sense?
Yep.
Awesome.